Jared, let's bring in our first guest for the hour. We've got Lori Calvasina, RBC Capital Markets, head of U.S. equity strategy. Lori, it's good to talk to you today. I've been keeping a close watch on the majors here as we've been talking about gas prices because it's kind of been teetering here back and forth. A split picture right now with the NASDAQ, the only one in the green. But what do you make of some of the market moves away from oil as we see Western countries continue to come down on Russia?
So I'll tell you what I noticed. And first of all, just thank you for having me. It's always a pleasure. But look, I'll tell you what I'm noticing on my screen today is the Russell 2000 has been, pretty consistently in the green, slight green, not major green, but is showing some resilience relative to some of the other indexes. And I think that's very interesting because what it's signaling to me is that the U.S. is still being treated as a safe haven from an equity perspective at this point in time. We saw this back in the China trade war initially, really kind of in the spring and summer of 2018. That before the world got to a point at which they thought the U.S. would be dragged into a global recession created by the China trade war, that the U.S. was the best game in town. So you had some safe haven seeking. Eventually, that argument kind of fell through the wayside. But what I'm noticing today, just with that Russell 2000 resilience, is just this idea that there's some faith in the ability of the U.S. to hold up.
And despite the market carnage that we've seen intermittently this year, I'm wondering if there are any spaces where you're seeing opportunities. Specifically, I'm looking at the Wi-Fi Interactive now. I'm looking at our software heat map over the last 3 months, and some of these names have been absolutely decimated. Shopify down 65%, Snow down almost 50%. Lots of dark red on the screen there. I'm just wondering if you're seeing any opportunities, maybe in some of these beaten down growth sectors.
Yeah, it's a great question. And look, our call coming into the year is we thought value was going to have its moments in the sun to start the year, but that eventually market leadership would return to the growth trade. And part of our reason for thinking that the market would eventually return to the growth trade would be that the valuation froth would get pulled out. I think a lot of that has happened at this point in time. Tech is back down to neutral on our sector valuation models. And we also said that the world was going to start thinking about a return to average type GDP growth in 2023. Typically, when the economy is running cool, growth stocks like tech tend to outperform. Value really only works when you're in a hot economy. And I think what's happening with this crisis in Ukraine and also some of the reverberations from the Fed actions is just this risk that we're going to see GDP expectations moderate back down towards trend a bit earlier than anybody anticipated. So that's a long-winded way of saying if the economy is set to slow and slow a little bit faster than what we thought, but not quite tip into a recession, that gives you fundamental support for this tech trade that really, has seen a lot of the valuation froth out. Now, I would qualify that a little bit because not everything that people necessarily think about as being tech is in that tech sector. When I talk about tech, I'm talking about kind of more of the corporate side of tech, but things like communications equipment, things like hardware and equipment, also the software and IT services space and semis.
Lori, going back to your case for small caps, though, is this partly about really reducing exposure internationally, looking at those companies who have more strength domestically because it is so noisy when you look outside of the U.S.?
I think that's fair. We continue to see people asking for lists of stocks with Russia exposure. And I keep telling people, first of all, most companies are not required to disclose country level revenues. But then you also tend to see that there's not a lot of exposure there to begin with. We did a survey of our analysts back in mid-February, and we actually asked industry by industry, if Russia invades Ukraine, do things like slowing economic growth in Europe, commodity price increases matter? What about end market demand to Russia and Ukraine? And very few of our analysts said that there was a material exposure of their companies and their covered industries to Russia and Ukraine. So I think you're right to use the word noise. I think that when you see international issues flare up, we often see people just dump money back into the US as a safe haven trade, and doing it through the Russell 2000 is a very, very easy way just to get that US exposure in a hurry.
And Lori, we got time for one more. Big Fed meeting next week. Also got a CPI print this Thursday. What are you expecting?
I'm expecting no surprises next week. Look, I think I've worked with a fantastic economist and rate strategist who had us prepared for a hawkish Fed. They never quite got into the camp where they were looking for a ton of increases this year. I think our team is now looking for 5 total increases this year, really more in the 25 basis point category. So, I'm hoping we have a boring Fed meeting next week, to be honest.
I think we could all use a boring Fed meeting next week, to be honest. Thank you for that. Lori Calvasina, always good to be talking with you. RBC Capital Markets, head of U.S. equity strategy.